It gives me great pleasure to start a new series, Greed and Fear, with none other than the market maverick Samir Arora. I guess the debate with Indian investors is not where the economy is headed, not where the earnings trajectory is headed. Things are looking, we've come on the right side of the COVID bump, at least financially speaking. The relevance of IT, the relevance of manufacturing, the relevance of startup has only increased. Given how China is unfolding, how the news in China is unfolding, the developed market growth is still very, very anemic. Indian economy and Indian corporate sector is in a good spot. This is a great time to invest as an entrepreneur. But is it a good time to still invest or stay invested? How much of the good news is in the price? And where is this bull market headed? Is there complacency? Is there greed? Or it's time now to really take some chips off the table? Samir, I guess the introduction was the question in itself. It's a great time to invest if you want to do business in India, if you're an entrepreneur, or if you're in the startup space. But for a public market investor, given where the markets are, we are at 60,000 on the Sensex.
So the thing is, if you believe in all the things that you said, then there is no question that it's also a good time to invest in the stock market or equities. The only thing you may say is, oh, the party was, if you compare the party to what has happened in the last 1 year, then obviously the party will not be as good. But it cannot be really that different if you say entrepreneurs are doing well and foreigners are coming in and the economy is doing well. You may say sometimes that for some stocks, maybe it's discounted it too much and therefore they will either not go up or may underperform. But you can't have these two things going totally different beyond a few weeks here or there. So if you believe the first part, this discussion is over.
But Samir, they say that markets are forward looking and markets they tend to discount the future. How much of the future are markets discounting in? Are they discounting 2 year forward, 1 year forward, 3 year forward?
So actually, if you look at how people are looking at earnings, at least in terms of the sell side, which is only entity which is putting down formal numbers as to for which year are we looking. And these guys are all looking at 23 March and even a little bit of 24 March. So I would think that, and I agree with everything, that India is doing well relative to the world and in absolute, and maybe after a few years of false starts, which got interrupted because of different events that happened in our country or economy or market or whatever, that things look a bit more smooth. So you may change a few stocks or you may reduce the focus on a few things. And I would think today that in terms of absolute greed and outright inconsistent with history or becoming nervous are two things. One is the IPOs and the extent of oversubscription in what look like totally normal companies to me. And secondly, some investors saying, which is of course first time maybe in hundreds of years, that valuations don't matter in investing. So these two look like extreme to me. Others look like normal. If you look at the performance of the financial sector, it doesn't look that it's gone anywhere. If you look at the performance of many of the IT companies, it has much better than what we may have thought 2-3 years ago, but it's still you can justify it. And then there are some companies which are from sectors that previously were not doing well, like real estate and all, which now, or even an L&T type, where you may look at it without feeling that you're coming in at some absolute, obscene high valuations of these companies or just plain prices.
Samir, we'll get into individual themes, but the other question which I guess I would like to understand your thoughts on is that we've outperformed and we've outperformed in a stunning manner. In the month of September, world came tumbling down and we are at a new high. So the actual outperformance is in double digit. Will this outperformance sustain or somewhere get challenged?
No, over time, I don't believe that we should outperform by this extent. So if you see this year now, the Indian market must be up some 25-30%. And now the US market is up 15 and China and all are down or whatever. But if you look at it over 3-4 years, it doesn't look that India has outperformed, say, at least the US and all. So I would think that this was a phase which whatever we were saying about fundamentals being strong, being recognized, and relatively India getting some benefit. So even though we have not had much foreign inflows from the time this China problem came up, starting with their attack on the education sector, but maybe the other markets have had massive redemptions and we've not had. It's not that we've had massive inflows, and so maybe the Indian fund managers and the retail and all are preempting a little bit of that relative attraction of India versus other emerging markets. But overall, the idea is not, see, the idea is what is an Indian investor supposed to compare to? First is he has to compare and say, A, am I going to lose a lot of money? Because everybody knows that over time you make a lot of money in markets. So the question only is the current timing so off that I will end up wasting the first 3-4 years in recovering from that, or 2 years recovering from that? And second, if you are saying that is okay, is will you do better than your alternatives? That for an Indian investor in 90% of the cases is only Indian fixed income. It is not US market. But overall, you want the globe to move together a little bit. It'll be very rare, like say in September, that the US market is down 5% and we were up, I think, 2%. That over time, outperforming is possible, but going against the grain in terms of rest of the world falling and we are going up, that makes it tougher and tougher.
So what is the risk for an investor? I'm talking about the big picture risk. Is it time, or it could be substantial on the price as well?
So right now the assumption is that it is neither actually, but definitely not that there is a prospect of a big fall. So let's look at it where the previous big falls have happened and what had happened prior to that for that fall to, in at least in hindsight, be justified, if not at that time. So if you see today and we say what should be the expected returns from the stock market, which would make you feel comfortable. So we saw for the last 25 years, the average return, annualized return has been 14%. But there has not been a single year in these 25 years where the returns were anywhere near the 14%. So if I looked at it as 12 and 16, saying, did the returns in any one calendar year fall between 12% and 16%? Not a single year since 1996 had that, even though the annualized return was 14%. So first thing is that you have to play it a little longer in terms of going in. But do we feel today that this can suddenly be a very off time, or one of the worst times that you could have invested in this phase? The only way to look at it is what happened in the last 1 year, which looks very high, that there can be a correction from that angle, that the returns are very high. But you go back 3 years and 5 years and 10 years from today, and the returns are broadly in the range of 15% again. Whereas if you had seen the same numbers from end of 2007, and you had seen previous 1 year, it was very high, some 40%. You had gone back 3 years, it was very high, some 45%. You went back 5 years, it was very high, some 45%. So for 5 years, annualized returns were 45%. In India, last 5 years would be 15, last 3 years, maybe 18, 20. Last 1 year looks high. But it's not that people have raked in money if you have been invested for 5 years, 3 years, which has been more normal horizon. It is that this new crowd of investors who have come in last year because of whatever lockdown or not going to office or whatever, they have this feeling that you're supposed to make 30, 40%. I don't think any of the older guys think that you're supposed to make 30% annualized return. So if you reduce your expectations to reality, then it's okay. It's a great market as it has been. And it doesn't even look that you will first lose and then make. It looks that you will be plus minus here, there, or gradually go up, but doesn't look like a bad time to start. It is a bad time to put everything perhaps in one shot, but it's like any other normal period in life, other than saying, oh, I should have invested everything in March 20 or in, say, September 20, and I missed that, so therefore now I don't like it.
To spend 30 seconds and bring this point out for our viewers. What Samir is saying that if you look at the Indian returns for last 10 years, the average return is about 2 to 3% more than the nominal GDP. That's how earnings in India have grown, which is anywhere between 14 to 15%. Last 1 year, put the chart out in last 1 year, last 18 months, the return obviously will look magnified. But last 3 years, last 5 years, returns have not been 30, 40% that we can feel very worried about. So Samir, they say that markets will always overshoot. if this bull market has to overshoot, are we in for 2-3 years of maybe 20%, 25% return plus before the real peak happens?
So, I refuse to think in that direction, because my point is that if I thought that the market will go up 12%, let's say, or 15%, I would be as happy, as bullish as anything else. And if you get more than that, we will, of course, take it and not say, oh, we've got more than what we thought we should get. What I mean is, you don't have to plan for a 20%. You don't have to invest on the basis that you will get 20%. Because if you even get 12-15%, your asset allocation should be exactly what it is. If I told you or thought, or you thought yourself, that the returns in the beginning will be minus 10-20%, then you may change something. You may say, I'll wait for a few months. I will do this, I will do that, I will invest later, whatever. But today, if you agree with us broadly that you will make reasonably good returns, it doesn't matter if you end up making much more. You're not supposed to leverage. You're not supposed to not buy a house and invest it in the market because you think that the returns might be 20. So don't think like that. Don't think this is 2003. Just think whether it is so out of line that you won't make even a 15% kind of number, which is the historical average, and a reasonably big premium over what else you can do in terms of fixed income. And that is your asset allocation thing.
Samir, we've seen the history of markets tell us that there are big phases where one market or one particular sector does very well. It was Japan in 70s, followed by the TMTs for US market. Last couple of years were dominated by China. Given what is happening in the world, how China is unfolding, how growth is anemic in other parts, next 4-5 years, can I say, belongs to India?
I think it can, yes. So there were two things. One is that US has had a massive run from 2009 onwards. So US returns, I think in dollar terms, are some 16-18%. Please check. I forget the exact numbers, but they're pretty obscenely high for US, where the average returns have been, if you look at longer term, maybe 8%. So to get 18-20% for a long stretch of 10 odd years is very high. India itself has actually done quite badly for the last 10 years. If you look at it from 2007 December in dollar terms, I think the return is some 5-6% per annum. So if you look at it from previous peak, there is no real high that you have achieved. And now we can see a few of these reforms coming together, and the investors or foreign investors or FDI guys or private equity guys also reacting to it. So it's no longer just a hope. And then China has shot itself in the foot, which takes 3 to 4 times the money that Indians get in terms of foreign flows and all. And therefore, even a little bit of a reallocation from there to a similar sounding market for a foreigner, which is China. India would, I guess, be put in one bucket. So you take away a few percent from that allocation, the most natural beneficiary of that would be India. It has not happened yet in terms of flows, maybe because there's so many things happening together that they are first protecting what they have there and taking it out, and then the US issues and all that. But as things stabilize, that relative attraction of India just has to go up. There is, it's not possible that in this time period China will again recover its position in terms of confidence of the world, because they are doing so many things back to back that it doesn't look that suddenly next day if they say that now we have finished, the people will be very excited and put the old allocations that they had.
Samir, who would have thought that we could be staring at a 10-year plus bull market for US equities? And the bull market is not dead yet. It is the longest bull market after Second World War, and it is still alive and kicking. In hindsight only, we'll figure out where this bull market ends. But are we in for that kind of a crazy bull market in India?
That's what I'm saying. The thing is that if you say like that, maybe your behavior changes a little bit to taking even higher risk and coming and saying that valuations don't matter and that every IPO has to be oversubscribed 400 times. I said, don't do like that. Don't get carried away. Do a high allocation to equity as you should if you are younger and you have the money and all that. Whatever comes, we will take and be grateful. But you don't want to put a strategy on that basis. The strategy is on the basis that equity will do better than debt, that you will not regret putting money into equity over a slightly longer time, and hopefully more or less in 1 year, 2 year also. And if you get more, we will say thank you very much and remember these interviews. But you don't have to say today, oh, I must, we might get 30% per annum, because that means you are trying to shift a guy who was not happy with a 20% return. So therefore, the fund manager or the commentator or the analyst said, you need 30% per annum. So suddenly the guys on the margin got also excited. I don't think our market needs those kind of people. If it comes, we will take it.
Samir, normally bull markets, they follow a leadership. It was TMT, then it was largely a combination of commodities and infra, and then some would argue good quality, high ROC companies made a comeback. But right now we are staring at a big uptick in commodity and cyclical stocks. Those sectors are making a comeback, and on the other hand, the startup, which is the most exciting phase where internet companies are going public. This seems like a rising tide where everybody is benefiting. Never seen something like this before.
Correct. No, so that is true. So as a fund manager, the problem becomes tougher because everything is doing well, and you have to then say which one is doing better than the others or will do better than the others. But I think that over time, financial sector will make a bigger comeback, because right now the story is that these private sector old banks and all good banks, I mean, not the old banks, but the current private sector banks are being attacked by the fintechs. And these fintechs have found some golden formula. But if you just look at the number of fintechs, some 200 odd fintechs, and the fact that a few sort of fintechs that have got listed, for example, these housing mortgage finance companies which say we use data and we lend to the unorganized guys who don't have income tax record or a sales or a salary slip and all, aren't doing that well, even though they are lending to the most attractive sector, which is against, like on mortgage. But the fact is that over time, as you saw yesterday or day before, the Reserve Bank of India also saying that they will try and in some form, or some deputy governor saying that they should be regulated, these fintechs. I think in the end, you'll find that maybe we have overblown the story of fintechs, not because they are not doing something good, but because there are just too many of them. And we have seen in many sectors like telecom and previously leasing companies and all that, that in the end many survive. But India is not ready to handle 250 fintech companies all saying that we will take some data and we will give money to the retailer and we'll give money to a guy who wants to pay in 3 months instead of 1 month. The whole country cannot do that. There are just too many of those companies. And so in the end, I don't think investors will make a lot of money from private companies if they're all similar to the next company. And few will again win in the end. So I think the financial sector, that is the current financial sector, the listed financial sector, may over time have less pressure if it is found that regulations are being done for fintech, because that changes their complete model. Right now, you pass on the loan directly to HDFC Bank. If they say, please do seasoning for 3 months, story over. Khatam, it's over in one line and the story is over. So if Shriram Transport Finance has to, when it gives a loan and sell it as a priority sector loan, keep it on its books for some time and see seasoning. If they do it with fintech in one stroke, half the story is over, or maybe 100% of the story is over for many of them. So don't write off the current ones. We don't believe everything about new. The old ones who are adapting and can compete and generally are agile will also surprise.
Samir, there are not data points, but there are two indicators or two harbingers, if I may use the word canary in the coal mine, which sophisticated investors have always used are one, activity in the IPO market, and second, retail participation. They both are at its peak. Let's spend a minute trying to understand the retail participation. Do you think the retail investor this time is different purely because of technology and awareness? He's much more sophisticated than what we've seen in the previous cycles, and we should not look down at them?
No, I don't think that they are different, because the fund managers of previous time, at least themselves, were also technologically proficient and were thinking and putting thoughts, but they also all lost money. We all lost money in tens of companies or hundreds of companies. The idea here is that currently they are believing that equity markets are to make very high returns. In the end, they will be disappointed because an education fee has to be paid by everybody. An education fee, you can't get into anything in life and get free education. So I don't think that in the end they are suddenly more smarter than maybe their average retail guy is smarter than the average retail guy before because now he has an internet and an app. But an average retailer now is not smarter than an average fund manager of the 90s. And the average fund manager of the 90s also lost a lot of money. We lost a lot of money on many companies. So here the impression of the new crowd is that because I invested in March 2020 or April 2020, I am a hero. Because when the world was falling apart, see, I knew, no bull you knew. It was just that the world chose to do it from there. And the second is because that I see on Twitter when I say that the returns will be 15, 18%, they all say, ha ha, we made 30%, we made 40%, not realizing we are talking about longer term returns and not returns from 2020, May or June or whatever. So I think they will be disappointed. By the way, in the US, if you see the price of Robinhood, just the stock, it's fallen a lot. New clients enrolled or whatever, whatever is the word, accounts opened are down a lot. I think maybe 60-70% down in terms of new additions, in terms of new clients coming on board. All that will happen here also because everything in the world is the same plus minus a few months.
Samir, you're not a typical value investor, which is you don't like to buy things based on what is the cost of the land, what is the cost of the mine, what is the dividend yield. You like to buy growth at a reasonable price. That's your DNA when you bought into IT or when you bought into private banks. Where do you see a combination of decent growth and decent price in this market?
So first thing is why I don't buy value is that value should have a trigger. So in the past, people lost money, not now, but like real past, because you would just buy a value stock and hope that somebody will unlock it. But in the 90s, I used to do all these things and I realized that in India, nowadays a little bit you can see this activism. But otherwise, individual fund managers or investors were unwilling to take on strong corporates because the corporates have political connections and police connections and whatever connections, and no individual has the energy to fight. It's better to sell and move on. You could not take them to court, you could not change managements, you could not do anything. And even today, that still looks a very complicated way to make money. So if there is a value unlocking somewhere, we don't mind looking at it, even if it's not immediate, but broadly you see that there is somebody trying to unlock, because we are not going to do that effort. We are too lazy to write letters to managements and then take them to NCLTs and all that. We have better things to do. So today, in terms of value, I was saying simply if you look at the number one, the financial sector, and you say what has been the earnings growth or the valuation premium today relative to what it was 3 years and 5 years and 10 years ago for the same companies, it does not look that it is anywhere near a high. If you look at HDFC Bank or Kotak Bank or even ICICI Bank and just go back and say what were they trading at in 5 years ago, 10 years ago, it doesn't look materially different. What looks materially different, number one, is the consumer type companies which were trading at 25, 30 val PE. Of course, somebody will come and say P doesn't matter, which is another sign of ridiculousness. But if you say it was 25, 30 and now it is 80, you know that something has been re-rated for some story or whatever, and clearly over this thing. But if you look at the tech sector, it looks higher in terms of valuations, in terms of excitement about future growth. But for the moment, they are genuinely in their business boom period, and therefore we are letting it be. But pure value, there's no value, but relative valuation that you've not been pumped up beyond just the earnings growth that you've had over the last many years, I would think is the financial sector.
Samir, I'll take my chances at this one. On a scale of 1 to 10, do you think by the time this bull market will end, 1 year, 2 years, 3 years, we don't know, but could we go close to 1 lakh on the Sensex?
1 lakh means you want to make 66% more, right? 60,000 to 1 lakh. So 66% more in theory, you're supposed to get in 4 years, compounding whatever, 1.15 or whatever. This you ask Mr. Ramdev Agarwal, who wrote a 2 lakh target with an expected return of 15% per annum. But it can happen. It can happen because the thing is, if you say that if I say that you will make 15% per annum for 4 years, it doesn't look that exciting to the world. If I say your index will be 1 lakh, they say, wow, even though it might be a little lower than 15%. So maybe that's the right way to say it. Possible, very possible. Why should we not expect a 15% kind of return for 3-4 years? It can easily happen. It's just that it won't happen evenly. And that is the reason why equity markets, because they don't give consistent returns, but they give higher returns over time. Otherwise, there would be nobody putting money anywhere else if you got both consistency and higher returns.
There's a Punjabi tadka in your voice when I spoke about the number of 1 lakh. So, Samir, before we wrap, this market has spoilt us. We've not seen a correction. Do you think correction is overdue? Correction should come in. It is necessary and it is healthy?
So correction is defined as 10%. And a bear market is defined as 20%. 10% in an index is actually not so painless. It is quite painful because then some of the stocks fall 15-20%. So I would say if it falls slowly, or doesn't go up till the end of the year more than 3-5% here or there, and we get a time correction, if I have to hope, that is what I would want. If I have to wish. But I think a 5-10% correction is possible anytime. 10% but plus makes it look a bit serious. So I hope that. I'm not expecting that right away, at least until end of year. Also, please look at it that this quarter, that is the last quarter of the year, is normally the best quarter in the world and also in US. I think India also. I think Rhythm Desai had written a report on this once, that what are the returns from October 30th or was it October 1st to budget day, which was at that time Feb end. And now it is Feb 1st. But this period is generally a good period for Indian markets and also for US markets, because of excitement about the last quarter sales, or because expected allocations from all these big guys who may be allocating once a year, like pension funds and all, who rebalance. But generally, this last quarter is, I think, the best quarter in the US for sure, where they keep putting this data out and I just read it. And in India, I remember this. So I'm not expecting it right now. Let's not wish for it right now. Let's not spoil our holiday festive season with these crazy stories of big corrections.
Well, the Swadesh channel starts on Monday. तो हिंदी में बाइट लेते हैं समीर आपसे. आपको लगता है कि सेंसेक्स 1 लाख 3 से 4 साल में हो सकता है?
बिल्कुल हो सकता है, क्यों नहीं हो सकता? अगर, क्योंकि इसका जो आप रिटर्न एक्सपेक्ट करेंगे तो करीब 15% पर एनम का ही निकलेगा. एंड वो तो अगर आप लास्ट 20-25 साल का एक्चुअल परफॉर्मेंस देखें, जिसमें इंडिया की परफॉर्मेंस कई पीरियड में बड़ी गंदी थी, उसके बाद क्योंकि 2008 भी था उसमें, तो फिर भी 15% के करीब पास में रिटर्न मिला है. शुद्ध हिंदी में मैंने ये जवाब दिया है आपको.
समीर, थैंक यू वेरी मच, शुक्रिया. एंड अब हम दोनों लैंग्वेजेस में बात करेंगे आपसे, तो थैंक यू वेरी मच फॉर ज्वाइनिंग अस.
थैंक यू वेरी मच. थैंक्स अ लॉट.